Rohr here with an early global view on Wednesday, July 30th, 2014. We are a bit earlier than usual this morning because we wanted to get this completed and posted prior to the release of the first look at U.S. quarterly Q2 GDP this morning. That's going to be important. So getting on to the actual implications for how the market is acting this morning after yesterday's concern over the increased sanctions over in Russia for Russia over the Ukrainian situation, how that might also have a backlash into weakening and already weak Europe. The equities sold off pretty good. Now that was after being higher through a good deal of the morning and then only taking pressure after the attempt to rally in the lunchtime. And in fact, this morning the S&P is up about 4 at the 1967 level. Now, interesting in the last couple days have been the down breaks and up breaks that haven't seemed to work. And 1967 is getting very near the 1968 up break out of the short-term downtrend the market put on yesterday in the the market put on Monday in the lunchtime and held on the initial test yesterday into mid-morning. And when you see again, down breaks through these channels don't seem to work, seems to be negated, then the market fails right back down. There's one answer for why this is. It's called geopolitics. When overriding themes kick in that go beyond anything people are looking for in the economic indicators, you can overrun near-term technical levels both ways. However, what we have to say here is that we had pointed out that the formation of the broader pattern meant the mid to upper 1970s were likely to still be resistance, and that's what we got. And that 1960 is an interesting interim support, but with the bigger support down toward the 1950 pre-existing support level that was also the trading low on the late session sell-off back on the 17th. And we'll look at a bit more of that on the intermediate term charts. Also, this is going to be somewhat concise for a global view, insofar as quite a few things are following through pretty much as we expected. And right now, in fact, there isn't much to say about the short-term indicators. The chop of the last several days has left the stochastics and the MACDs fairly neutral. The one thing we'd look for is if we do drop below 1960 later this morning, does the 30-minute or 60-minute MACD drop below its lower runaway band? And that leaves us over looking at the intermediate term picture of the S&P 500. And we would, once again highlight two things. One, the degree to which this could be forming a complex left shoulder and the minor, choppy, narrow-ranging squeeze out to a head last week before the late week sell-off. And the potential, therefore, is for something back near that 1950 trading low. That's part of why it's so important. It's actually 49.30 going back to the 17th. But in the meantime, if it's going to conform to being a left shoulder on this side, it should conform to respecting the highs from these previous swings up into the 1978 area, which after the early strength yesterday is more or less what we got. And the higher resistance, on the other hand, is up to 1990 to 1993. That is 90 on the topping line and 135 over. 1858 is what we're going to call it, is 1993 on the oscillator resistance. That pretty much does it for the intermediate term view of the S&P 500.